Welcome, everyone. We're excited to have you be a part of our webinar on research opportunities concerning the FASB's new Leases standard, topic 842. I'm Jeff Mechanic. I'm an Assistant Technical Director here at the FASB, and joining me for today's webinar are Board Member Christine Bodizin, FASB Postdoctoral Fellow Shannon Garavalia, FASB Leases team members, Chris Roberge and Bobby Gwynn. And in the background, we have FASB Supervising Project Manager Joy Tsai and FASB Postgraduate Technical Assistant Justin Homestead. Again, all part of our team. Let's move on to the next slide. To the next one. The objective of this session, well, here's the agenda for the session, and Christine is going to start us off by talking about the objective of the session and provide us with an overview of our post-implementation review process here at the FASB. Then a combination of Chris, Bobby, and Shannon will take you through the standard as well as research opportunities related to the standard. We'll talk about the overall problem that the standard was trying to solve and the solution. Then we'll get into some specific topical areas and finish up with disclosures. And then finally, Shannon will talk to us about some future educational opportunities, particularly some upcoming webinars on research areas, research opportunities for other areas, other new standards. Some housekeeping items to start us off. First, CPE credit is not available for today's webcast, so I guess the one advantage of that is that you won't have pesky polling questions popping up every 10 to 15 minutes, just us and all these good research opportunities. Very importantly, to ask a question during the session, don't use the chat feature, use the Q&A feature. That will help ensure that we all see your questions and can answer them. We'll be stopping after each section to field your questions. So please enter them as you go along, and we'll get to them at these stopping points. The slides will be available for downloading on our website at www.fasb.org/academics, which is our academics landing page. But Shannon just, I believe, chatted that out to you, so you should be able to download the slides by just clicking on the link in the chat box there. And then finally, a recording of this webcast will be available online at both the academic landing page as well as the conference web page for the Accounting for an Ever-Changing World conference. And at least on our academic web page, so this will be available for several months at least, and I assume so on the conference web page as well. And then finally, if you have any questions about this webcast or any of our other educational webcasts, please contact Shannon at our academics landing page, again, academics@fasb.org. And with that, I'm going to turn it over to Christine Bodizin, who's going to talk a little bit about the objective of this session.
Thanks a lot, Jeff, and welcome to all of our visitors today, participants in this session. We really appreciate you taking time out of your day to join us, and I hope that you will share any questions that you have to make sure that we provide the most amount of information that we can during our time together today. So I'm going to begin with the objective of this session. If we can go to the next slide, thank you. Our objective is to provide an overview of the FASB's post-implementation review process and the role that academic research plays in PIR. We'll also review certain aspects of the lease standard and, as I said, answer any questions that you have about the guidance along the way. And finally, we will highlight areas of opportunities for academic research that are relevant to the PIR of the lease standard. It is not our intention today to state explicit research questions or to recommend particular research methodologies, but instead, to share some of the questions that we are interested in as we're going through post-implementation review, with the hope that you might then identify research questions of interest to both the academic community and the FASB. What we share today is going to be by no means, however, a comprehensive list. For example, the session is going to focus on lessee accounting because lessee accounting was the most impacted by topic 842. but please don't infer that we are uninterested in relevant research related to lessor accounting or other aspects of lessee accounting that we do not cover today. So going to the purpose of a post-implementation review. PIR is the process that we use to evaluate whether a major standard like the lease standard is achieving its stated objectives in a cost-effective manner. PIR has three main objectives. The first is to determine whether the standard is accomplishing its stated purpose. And here we look at whether the standard resolves the issues underlying the need for the standard in the first place. We also assess whether its application yields decision useful information. We also consider evidence about whether the standard is operational, results in any significant unexpected changes to financial reporting or operating practices, or gave rise to any significant unanticipated consequences. The second objective is to evaluate the cost of implementing and complying with the standard on an ongoing basis. And the last objective is to provide feedback on the standard setting process itself and where that might be improved. We have three active post-implementation review projects currently on the standards on leasing, revenue, and credit losses. There is information on our website pertaining to the PIRs of each of these topics, and links to those materials related to the PIR of these three areas are embedded in this slide. In addition to today's webinar on leases, we have upcoming academic webinars on revenue on March 19th and credit losses on March 26th. And registration is now open for all of these sessions. So if you or someone you know is interested in conducting research related to the revenue or CECL standards, we hope that you will join us again for those sessions. Next slide. Thank you. So to promote research that is relevant to the PIR of leases, revenue, and CECL, you may have heard that the FASB is working together with the ISB, the Accounting Review, and the American Accounting Association on the Accounting for an Ever-Changing World conference. The link to the conference website is provided on this slide. The conference focuses on research that is relevant to the FASB and ISB's PIR projects on leases, revenue, and financial instruments. The conference website provides links to relevant materials on both the FASB and ISB websites, including the ISB's academic webinars on leases, revenue, and financial instruments, which they have held over the last several weeks. We hope that today's session will provide some food for thought about the lease standard, its post-implementation review, and related academic research. And with that, I'm going to turn things back over to Jeff to introduce the next section of our presentation.
Terrific. Let's just say I don't believe I saw any questions, right, that have come in. Let me just take a quick look. No, I don't see any open questions. Okay, so let me then turn this over to Chris Roberge, who is going to start talking about the what we were trying to solve with the new Leases standard.
Thank you, Jeff. If we go to the next slide, spend a little time on that. In this section, I'll provide a high-level overview of lessee accounting under the new guidance. As Christine had mentioned, we're not going to discuss lessors today, but that does not mean that we're not interested in research on lessor accounting. The biggest change to lessee accounting is that operating leases are now recognized on a lessee's balance sheet as lease liabilities and right of use assets. I'll refer to those as ROU. Whereas under the previous guidance in topic 840, lessees were required just to provide disclosures for their operating leases. What necessitated the change to the lease guidance? In 2005, the SEC staff released a report on off-balance sheet arrangements to address whether current financial statements of issuers transparently reflected the economics of off-balance sheet arrangements, such as operating leases. The report included a recommendation that the accounting guidance for leases be reconsidered. The report noted that there may be approximately 1.25 trillion non-cancelable future cash obligations committed under operating leases that were not recognized on book. Additionally, a number of academic studies published over 15 years preceding the issuance of the new leases guidance have recommended that changes be made to the existing accounting requirements to ensure greater transparency in financial reporting and to better address the needs of users of financial statements. If we go to the next slide, please. This slide shows you, just the amount of work that was done by the staff and the board at the time. There was a discussion paper that was issued in 2009, 2 exposure drafts, 2010 and 2013, and then the final issuance of ASU 2016-02 in 2016. So as part of the due process that led to Topic 842, the board conducted extensive outreach with users, preparers, and auditors of financial statements to obtain information about specific deficiencies in the accounting requirements for leases in previous GAAP. Input was received both before the project was added to the board's agenda and throughout the duration of the project. The outreach really indicated that most users considered leases to be a liability and adjusted a lessee's financial statements to capitalize operating leases when they were significant to the lessee. Those adjustments were often based on incomplete or limited in information that was disclosed. Many use techniques such as multiplying the lessee's annual lease expense by a factor, often in the range of 6 to 8, to approximate the fair value of lessee's obligations and to assess, for example, total leverage and the capital employed in operations. Additionally, the existence of 2 very different accounting models in which the assets and liabilities associated with most leases, that is operating leases, were not recognized, but were recognized for a minority of leases, that is what was referred to as capital leases, now finance leases, resulted in transactions that were economically similar, but accounted for very differently in the statement of financial position, that reduced comparability for users and provided opportunities to structure transaction to achieve a particular accounting outcome. To address those criticisms, the board decided to modify the lease accounting model and require a lessee to recognize assets and liabilities for the rights and obligations created by operating leases. The board developed Topic 842 principally to improve users' understanding about lessees' obligations under lease contracts, to increase the decision usefulness and comparability among organizations by recognizing operating leases on book and disclosing key information. There are certain new disclosure requirements in Topic 842 for which we will discuss in a little more detail later in the session. In the next few slides, I'll provide an overview of the new lessee accounting model, starting with lease classification. So we still have the 4 of the legacy classification requirements to determine whether a lease is a finance lease or an operating lease. There is a new requirement which is circled, but the requirements are: the lease transfers ownership of the underlying asset to the lessee by the end of the lease term. 2, lease grants the lessee an option to purchase the asset that the lessee is reasonably certain to exercise. Lease term is for a major part of the remaining economic life of the underlying asset. That's often referred to as the 75% test. The present value of the lease payments and any lease residual value guarantee not reflected in the lease payments is equal to or exceeds substantially all of the asset's fair value, often referred to as a 90% test. And the new requirement is that the underlying asset is such a specialized nature that is expected to have no alternative use to the lessor at the end of the lease term. So if any one of these is tripped, the lease is a finance lease. If not, it's an operating lease. Now, it's important to note here that we diverge with the IASB on this, their leases standard, IFRS 16. They only have for lessees one classification for leases, which is consistent with our finance leases. And we will have questions for you and have that as a top topic for you to consider in your research. So if we go on to the next slide, just a lease is a contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment, which is the identified asset for a period of time, the lease term, in exchange for consideration. As I mentioned in the first part of my tee-up, the lessee has a right of use asset, which is based off of the lease liability that it recognizes. Now, when you look at how a lease is defined, first thing that's in bold, or part of a contract. What we're trying to get to there is that a lease doesn't have to be tabbed a lease contract. You can have a lease that's embedded in another contract, such as a service contract, often referred to as embedded leases, and that's been discussed a lot as a standard was applied, noting that the board did not intend to significantly change how a lease was defined, and therefore it wasn't its intention to capture more contracts that would qualify as leases. We get to that conveys the right to control the use of identified PP&E. Here, what the board tried to do and did was align the control principle in the leasing guidance with the control principle in topic 606, revenue recognition, and topic 810, consolidations. And then an identified asset, they could be explicitly called out for in the contract, or it could be implicit. And we will also talk about for a period of time lease terms and the judgments that go into that to determine the lease liability. A lessee will discount the remaining future lease payments, which are generally fixed, and will determine that liability of which the right of use asset is based on. Note that variable payments, which we will also discuss later, are not included in the measurement of a lessee's lease liability, and therefore could be considered an area where structuring could try to be achieved. And then if we go to the last slide that I'm going to talk to, just the counting for a finance lease and an operating lease, the balance sheet treatment is the same. You have, like I said, you have both a right of use asset and a lease liability. The income statement is where they diverge in the income statement, a lessee will recognize for a finance lease an amortization expenses along with an interest expense. And for an operating lease, it'll recognize a single lease expense, most often on a straight line basis. And finally, in the cash flow statement, for a finance lease, you'll see cash paid for principal and in interest. Cash paid for principal will be within financing, and then for an operating lease, cash paid for lease payments will be in the operating section of the cash flow statement. I just would also like to point out that there is a recognition and measurement exemption for short-term leases with a lease term that is less than 12 months. And so that's going to hinge on what your lease term is. Notwithstanding, that does not, that a lessee is still required to disclose in its financials the amount of short-term lease cost that was recognized for a period, so users can understand the composition of lease costs. And finally, other than public business entities may use a risk-free rate for measurement of all of their lease liabilities. And currently, that election needs to be made at an entity-wide level. So I believe that's the last of my slides. And I don't know if we have any questions. Be glad to
see any unanswered questions.
Okay.
So
Well,
with that,
you.
I'm going to turn it over to Shannon Garavaglia, who's going to talk about the research opportunities on these broader aspects of the Leases standard.
Thanks, Jeff, and thanks to Chris for that overview of the standard. So as we talk about the different questions of interest to the FASB as it relates to the standard, we're going to tie everything back to the PIR process as outlined by Christine at the beginning of the presentation. So everything kind of fits under this umbrella of whether or not the standard is accomplishing its stated purpose. And then from there, we have kind of some sub-questions that again tie to our PIR process. And so that first sub-question is whether decision useful information is being reported to and used by investors, creditors, and other users of financial statements. So when we think about this standard in particular, we're curious to know, has the decision usefulness of information about lease assets and lease liabilities improved? So that was obviously one of the stated purposes of the standard, and we'd like to know if it's being met. Not only this, we're interested in whether or not the decision usefulness of the information differs by the type of user. So broadly, does it differ, but then also has it improved or changed by type of user, such as equity versus credit investors or analysts, or buy side versus sell side analysts, different cuts that you can imagine here. Next, we're interested in whether the comparability of information has improved regardless of how entities choose to finance their assets. So again, comparability, increased comparability was one of the stated purposes of the standard, and has that been met here? And then last, how do the amounts that are recognized on the balance sheet in the year of transition compare with the amounts that were disclosed prior to adoption and users' estimates of leased assets and liabilities based on those disclosures? So Chris talked about some of the adjustments that users were making to try and estimate these things. How does that compare to the actual amounts that we're seeing recognized on the balance sheet now? The next sub-question that we're interested in is whether or not the standard is operational. So for this, first and foremost, we wonder what is the nature and magnitude and drivers of the implementation and ongoing costs of Topic 842. And for those of you out there who don't do financial research, you maybe think about audit research. This is a good place where we think we would be interested to learn more about what operational challenges auditors have faced as a result of Topic 842. Chris also talked about the dual classification model in Topic 842 and compared that to the single model under IFRS 16. In line with the objectives of the conference, we're interested in learning more about how that divergence has affected users. So first, does the decision usefulness of the information differ between the two models? So between our dual classification model and the IASB's single model? And then again, does the decision usefulness of the models vary by the type of user? So those same users that I outlined on the previous slide or other user groups. And then what is the impact on the comparability of information? So we're interested, again, broadly in comparability in the standard, but especially as it pertains to the difference in these two models. And then last, do implementation or ongoing costs differ for entities who are abiding by either of these standards? The third sub-question that we are interested in is understanding whether there have been significant unexpected changes to financial reporting or operating practices as a result of the standard. The first sub-question here that relates specifically to the leasing standard is whether there have been any implications for debt contracting. And we broke this down into two additional questions. So first is, how has the transition to topic 842 impacted existing debt arrangements? So we heard anecdotally that this might have an effect on debt covenants. Any large sample research in that front would be helpful to understand, or other changes to existing debt arrangements. And then secondarily, how has it affected new debt contracting? So have there been changes to debt contracting post-topic 842? For example, are operating lease liabilities and finance lease liabilities assessed differently during the process? Next, we're curious to know if there's been an impact on lease versus buy decisions as a result of the change to the standard. In addition, has there been a change in the efficiency of lease management practices or lease contracting, or a change in the efficiency of asset utilization? So these are some things we've heard anecdotally in outreach, but again, we really turn to academic research to help us understand on a large sample basis whether these things are pervasive in practice. And the final sub-question is whether there have been significant unanticipated consequences that have resulted from applying the standard. And so here we're wondering, have lease transactions evolved to achieve a particular accounting outcome on the statement of financial position? So Chris did a nice job of outlining some of the changes to the accounting for leases. So we wonder, have the way that those accounting changes have manifested resulted in changes to how actual lease transactions are being conducted? For example, are there greater variable payments, shorter lease terms? Chris mentioned that 12-month or less lease exception, so maybe we might see some differences there. Increased use of service arrangements, change in the mix of operating and finance leases, really any of these things that were not necessarily an anticipated consequence, but we can certainly see how they might arise from the change in accounting standard. And with that, I'm going to turn it back to Jeff.
Yeah, it looks like we may have possibly one or two questions.
Yeah, it looks like Chris is going to answer this question from an attendee who has asked, can you talk about some of the differing assumptions at the FASB versus IASB that resulted in two different models? And they asked, why did the FASB and conversely the IASB think finance and operating would be more or less decision useful? So Chris?
Sure, I'd be glad to take that. I think there's two things to consider here. I think that the board was one, convinced when you look at the classification criteria that we went through, that there was a difference between a lease with terms that results in an operating lease being not really akin to debt, or at least as much as a finance lease, which is really because of the fact that it meets one of those criteria, seems to be more akin to a purchase of an asset. The board also took into account significant feedback from preparers that retaining the two classification model would allow preparers to leverage their existing systems to comply with the standard. Now, I'll end by saying that although that was an assertion that was made, what the staff has learned and has been conveyed to the board as well is that there were significant upgrades or new systems that were required to comply with the standard. So hopefully that's helpful.
I could also just add something that I've heard as we've been going through outreach with users on this particular issue of the dual versus single class of model. And, it seems that whether a user likes it or doesn't like it kind of depends on what they're trying to do with the information. So if it's an equity analyst and they're primarily focused on forecasting future cash flows, then they have a tendency to prefer the straight line amortization, shall we say, or the straight line expensing under operating lease accounting because it matches the cash flow more directly. But for those users that are more interested in assessing solvency and debt ratios, they often will prefer to restate the financial information to treat all leases as financing leases, in which case the question then becomes, do they have sufficient information to make the adjustments that they want to make? So I found that to be interesting because I think I went into this sort of with an academic view that the single model was sort of the most representationally faithful of the underlying economics, and it was sort of the right way to go. But in talking to users, it isn't necessarily consistent with that perspective.
I think we've received one or two other questions. Let's see if anyone wants to answer those.
Yeah, I mean, so one of the questions I'm seeing here is with regards to the classification criteria, the new standard incorporated more subjectivity, for example, substantially all of the economic life as opposed to 75%, et cetera. What was the intuition and rationale for this change?
Yeah, I could take that. In the implementation guidance to the standard, it provides an acceptable interpretation of that being what existed in prior GAAP. Notwithstanding, I think that the board wanted to leave room for judgment. If someone had had lease payments and the present value of those lease payments was 88% of the fair value of the underlying asset, I don't think they wanted to preclude someone from a conclusion that it was a finance lease. I still think in practice, from what we've learned, it's being applied as it was prior, using the bright lines. But I think the intent was to provide some room for judgment to be used.
Okay, thanks, Chris. Any others that we want to answer at this time, or we could also answer them a little later?
So I also, sorry, Shannon, go ahead.
I was just going to say one more question to maybe answer now. Someone asked, the straight line amortization under the operating lease seems to result in a depreciation expense recognized on a decelerated basis. Any issues or questions raised by stakeholders in this regard?
Well, it's not a depreciation. Really what you have is that the accounting on the balance sheet between interest and the amortization of the right of use asset is just a mechanism to recognize a straight line lease cost that will be the same for the most part in each period presented. So under an operating lease, you're not showing a depreciation expense again, it's just a way to get the straight line, to get the right of use set to zero at the end of the lease term, and ensure that the total lease cost is recognized. Total undiscounted lease cost is recognized on a straight line basis through the lease term.
And I was just going to say, with respect to the questions that came forward about market microstructure and the effective implementation on aspects of market microstructure like the bid-ask spread, we would certainly be interested in any findings related to the impact or the relationship between implementation of the standard and what's going on in the capital markets. And so if that's the area that you're interested in researching, we're not, attempting to address all of the different areas that research could be conducted. So I would say if you have a research question in mind, go ahead and do it. And we'll be interested in taking a look at your results when you're done. All right, I think we can probably move on unless, I don't know, Chris, do you want to address the question about why preparers oppose the standard?
Sure. I mean, I think that less on book was what was preferred. I mean, as I tried to note in my tee-up, is that leases could be structured to stay off book, stay off balance sheet. It's less work too. An operating lease that's not recognized on balance sheet, you're just booking your lease expense probably on a straight line basis from period to period. So it really didn't require a lot of work on behalf of preparers. Just most importantly, it was the disclosures that were important to users, particularly the commitment table, the 5 years and then thereafter of undiscounted future lease payments. So yeah, I can see why they opposed it. I think it was something that they would have preferred remain off book.
Okay. Again, there may have been one or two other questions, but we'll have time later on to catch up on questions. So I'm going to turn this over to Bobby Gwynn, who's going to take us through some of the specific topical areas of the standard.
Thanks, Jeff. Next slide, please. Thank you. In the next couple of slides, I'm going to talk about two key concepts that directly determine the amount of lease liability and right of use asset that a lessee recognizes on its balance sheet: the lessee discount rate and lease term. Starting with lessee discount rate. Lessee's determination of its discount rate in a lease is essential because it directly affects lease classification as operating or finance, and the measurement of its lease liability and corresponding right of use asset. Additionally, if the lease is classified as a finance lease, that rate is used to calculate the interest expense in the subsequent periods. Topic 842 requires a lessee to use the rate implicit in the lease if readily determinable, and if not, the lessee uses its incremental borrowing rate. This requirement is similar to the previous gap. In practice, both under 840, the previous gap, as well as 842, lessees are generally not able to determine the rate implicit in the lease because they're not privy to the lessor assumptions necessary to calculate that rate. For example, the lessor's initial direct cost or expected residual value from the asset. So in practice, lessees, both under previous gap and under current 842, default to using their IBR. The definition of IBR has changed in 842. It requires a lessee to use a collateralized borrowing rate. It's defined as the rate of interest that a lessee would have to pay to borrow on a collateralized basis over a similar term, an amount equal to the lease payments in a similar economic environment. So the requirement to use a collateralized borrowing rate is a new requirement. The previous definition required a lessee to use the rate that the lessee would have incurred to borrow over a similar term the funds necessary to purchase the leased asset. So one, there was no requirement to use a secure borrowing rate. And two, the funds necessary to purchase the leased asset is different from current requirement where a lessee is required to determine the interest based on the amount it would borrow on a collateralized basis for an amount equal to the lease payments, not the amount necessary to purchase the leased asset. So those are some key differences in the definition. And this is one of the areas, IBR, incremental borrowing rate, where a lot of time and resources have been spent by public business entities in implementing 842. We have been doing a lot of outreach to understand, was it the change in the definition that necessitated that? What we have learned is that the change in definition, of course, lent to the increased cost because there was time and resources spent to interpret the new words and understand how to apply it. What we also learned is that regardless of the change definition, whatever rate, had it been the 840 rate or any other rate that would have been required, it would have gone through a lot of scrutiny because of the fact that that rate is used to determine the lease liability, an asset that goes on lessee's books now. Something related that I want to highlight here is that Chris mentioned it earlier too, is the non-public business entities have an option to use risk-free rates instead of determining IBR to measure the lease liabilities, and that election is an entity-wide election. Another thing to highlight about lessee discount rate is that the rate once established for a lease at lease commencement is not reassessed. It is reassessed if the lease term is reassessed, and we'll talk about it in the next slide, or if the lease is modified. So with that, if we could move to the next slide. In this slide, we're going to talk about the lease term. The definition of lease term has not changed significantly. It's the non-cancelable period of the lease, and if there are any options for the lessee to renew or terminate the lease, at the lease commencement, the lessee would apply significant judgment and determine whether it's reasonably certain to exercise those options. Lessee would consider all relevant factors that create any economic incentive to exercise those options. Once the lease term is assessed, is determined, the new requirement for lease term is in the subsequent measurement part, which is to reassess that lease term. So the lessee is required to continuously monitor if any significant event or change in circumstances within the control of lessee occur, which would change its assessment of whether it's reasonably certain to exercise an option that it has. So for example, if a lessee has a 5-year non-cancelable lease with 5-year renewal options, and at the commencement, the lessee determines it's not reasonably certain to renew, to exercise those renewal options, but after day one, at some point in the non-cancelable period, the lessee makes an investment in significant investment in some leasehold improvement, and that is a trigger event now. So lessee would now have to determine, does that event affect changes its determination of whether it's reasonably certain to exercise any renewal option. Lease term is important because once a lease term is determined, the lessee would analyze what are the lease payments it's making, barring variable lease payments which do not get measured, which do not get included in the measurement of lease liability. So based on the lease term, the lessee looks at the fixed payments, in substance fixed payments, to determine what are the undiscounted cash flows, and then uses the discount rate to determine the lease liability. And then there are certain adjustments made for initial direct cost, lease incentives, and accrued or prepaid lease payments to that lease liability amount to get to the right of use asset amount. We can go to the next slide now. Another area that changed significantly under 842 for lessee accounting is sale-leaseback transactions. So a sale-leaseback transaction is where a seller sells an asset to a buyer and leases it back from the buyer. So the buyer is the buyer lessor, seller is the seller lessee. 842 provides significantly changed guidance to determine whether a sale has occurred. The first step in a sale-leaseback transaction accounting is to determine if there is an accounting sale. 840 refers to topic 606 to determine whether the control of an asset has transferred. 606 provides that an asset is transferred when the customer obtains the control of that asset, and control refers to the ability of the customer to direct the use of the asset and obtain substantially all of the remaining benefits from the asset. It also provides indicators, I think 5 indicators to determine whether non-conclusive indicators in isolation, but 5 indicators to be assessed along with the control criteria and to determine if a sale has occurred. So 842 refers to that guidance to determine if a sale has occurred. It also provides that if the leaseback would be classified as a finance lease by the lessee or a sales type lease by the lessor, then that precludes an accounting sale. It also provides that repurchase options, if a seller lessee has an option to repurchase the sold asset in future, does not preclude a sale if the option is exercisable at then prevailing fair value and there are alternative assets substantially the same as the transferred asset that are readily available in the marketplace. So this determination of whether a sale has occurred has changed significantly from 840. 840 did not include specific guidance for non-real estate transaction in terms of determining whether a sale has occurred. For real estate, it had separate guidance, and that guidance was very prescriptive and complex. And also under that guidance, most of the gains were deferred. The guidance under 842 is more principles-based because it refers to the notion of control in 606. And also, if there is a gain, if there's successful accounting sale and there's a gain or loss, that is recognized when the sale is recognized. So you wouldn't see deferred gains anymore. If the sale is successful, if the accounting sale is successful, the buyer lessor accounts for the purchase consistent with the purchase of any other non-financial asset. Seller lessee accounts for the sale, gain or loss, and then the lease back. If the accounting sale is not successful, then it's a failed sale lease back, and the entire transaction is accounted for as a financing. So any consideration that the seller lessee receives is like a loan, and any payment that the seller lessee makes on the legal lease is a payment of that on that loan. So with that, I'll check if I have any questions. See any?
Yeah, I don't see any. So why don't I pick up where Bobby left off then, and just go through some of the questions that we're interested in with regards to those specific areas that Bobby just reviewed. One of the questions that we would be interested in is how the application of judgment in determining the discount rate and lease term impact the decision usefulness of the measurement initially of lease asset and lease liabilities, and how the application of that judgment impacts the comparability of those measurements. We've heard quite a bit from users in outreach about comparability and the importance of comparability, but there is also sometimes confusion between comparability and uniformity. So any research that can shed light on those issues would be helpful to us. We also are trying to understand if the changes to the sale leaseback guidance improve the decision usefulness of the information related to those transactions. Is the information now more comparable to the information provided about other transactions that are economically similar but are not structured as sale lease transactions? And how is the comparability of the information, again, how is that comparability impacted by the judgments that are required in that area of the guidance? Sorry. We are also interested in understanding how entities select their discount rates and their lease terms and make those judgments in determining whether a sale has occurred in a sale leaseback transaction. Does the application of judgment differ across entities in systematic ways? And how does the application of judgment in those areas impact the implementation and ongoing costs of complying with the standard or the auditability of the standard? In addition, if we can go to the next slide, this might be viewed as part of assessing comparability, but to what extent are the significant judgments that are being made a faithful representation of the underlying economics? As we envision comparability, we would describe that as a similar economics being accounted for similarly. And so the question is, is that are those judgments that are being made representationally faithful of those underlying economics? And then last but not least, we also would be interested in whether there have been changes to sale leaseback transactions, whether they've evolved in response to the requirements in topic 842 to achieve a particular accounting outcome. And with that, I'll turn the reins back over to Jeff to see if there are any questions or whether we should move on to disclosure.
All right. Well, I don't see any unanswered questions at this point, so I guess let's move forward. Again, we'll be stopping after disclosures to check again, but let me turn it back to Bobby, who is going to take us through the disclosure requirements of the standard.
Thanks. The topic 842 includes a disclosure objective and certain specific qualitative and quantitative disclosure requirements. The objective of the disclosure requirement is to enable users to assess the amount, timing, and uncertainty of cash flows arising from leases. The board considered that including a disclosure objective allows an entity to understand the purpose of the disclosure requirements and the extent to which information about its leases should be disclosed. The guidance requires a lessee to consider the level of detail necessary to satisfy the disclosure objective and how much emphasis to place on each of the various requirements. Also, a lessee is required to apply judgment about the level of aggregation or disaggregation necessary to ensure that useful information is provided in accordance with the objective. So now we'll talk about the qualitative disclosure requirements. So 842 requires a lessee to disclose all of the disclosures listed on this slide. Information about the nature of leases includes a list of items in GAAP in 842. It's not an exhaustive list, but it lists out some of the items that I want to highlight here. Variable lease payments, if there are variable lease payments, what's the basis for that? For example, it's based on sales of a store. So those kind of narrative disclosures about existence of variable lease payments. If there is an option to extend or terminate the lease, so options that affect the lease term, existence of those options and terms and conditions related to that. Also, if there are restrictions or covenants imposed by leases, for example, a lessee is forbidden from incurring or restricted from incurring additional financial obligations. So those kind of qualitative information would be disclosed as part of the nature of leases. Additionally, leases that have been signed but have not yet commenced, but create significant rights and obligations for the lessee are also required to be disclosed. And this is a new disclosure under 842. The third bullet, and here, significant assumptions and judgments made in applying 842 is also a new requirement. Again, 842 has a non-exhaustive list of items that lessees would disclose here. So whether a contract contains a lease, an embedded lease, that is an area of significant judgment. So how did the entity determine that? Disclosures about that. If a contract includes lease and non-lease components, such as services, so how was the allocation of the consideration in the contract made? And also, how did the lessee determine the discount rate that's using for its leases? If there are sale leaseback transactions, again, qualitative disclosure about the terms and conditions of those transactions need to be disclosed. We have talked about short-term lease exemption. This is an accounting policy election. So if an entity makes this accounting policy election, they're required to disclose that. And another one in qualitative I want to add, it's not up here, is lessees are have been provided with a practical expedient where they can choose to combine lease components in a contract with the non-lease component, such as services in the contract, and recognize or account for it together as under 842 as following the lease accounting requirements. So that election is made at asset class level, and entities that choose that expedient are required to disclose that and the asset class level at which that election has been made. If you can go to the next slide, please. So here, these are the required quantitative disclosures. A lessee is required to disclose total lease cost separately for finance lease expense, which is broken down into amortization of right-of-use assets and interest portion. And operating leases continue to have a single lease cost in P&L. Additionally, you'll see short-term lease costs and variable lease cost. If there is any sublease income, gain and losses arising from any sale leaseback transactions. On the right-hand side of this slide, these are some of, except for the maturity analysis at the bottom, these are some of the new disclosures under 842. So there were some users, when 842 was being developed, there was a lot of feedback from users that they're unable to understand the cash paid for leases. So this is a new requirement that requires lessees to separately provide the cash paid for operating and financing leases. And the next one is non-cash supplemental information for lease liabilities that arise from obtaining RU assets. This could happen in case of lease modifications or remeasurement of lease term. So if there is a modification which leads to an increased lease liability and right-of-use asset on the balance sheet, but there's no cash or expense in that period related to it. So disclosures about that non-cash change in asset. And then there is weighted average remaining lease term disclosure and weighted average discount rate for leases that are required by lessees. The maturity analysis table, which provides, and if you can go to the next slide, please. The maturity analysis table is similar to the 5-year table provided under 840. So it's for the subsequent 5 years, it's the undiscounted cash flows, and then for the remaining years after that. And then there's a requirement to reconcile that undiscounted cash flows to the lease liabilities presented on the balance sheet. So with that, I'll check the question.
I think there's one question.
This relates to when before the end of a reporting period, a lessee has signed a contract, let's say in October, but it's a significant lease for that entity, but the lease would commence, let's say, in March of next year. So this relates to the fact that the definition of lease inception and lease commencement changed under 842. Earlier, there was lease inception under 842 was defined as the date you sign a lease contract. Now 842 uses lease commencement, the date when a lessee has the right to use the leased asset. So before a lessee can use it, it has signed a significant contract that would begin in a different period, in the subsequent period. Lessee are required to disclose that.
And I would just add to that, part of the question was about the rights and obligations that the lessee has. I think based on, you know, the assertions made in the new standard, we're not saying that they do have rights and obligations. What we're saying is that there's a commitment that they've gotten themselves into. And that's information that the board believe would be beneficial to users.
Okay. I don't see other questions, so I'm going to turn it over to Shannon, who's going to talk about research opportunities in the disclosure area.
Thanks, Jeff. So not surprisingly, a lot of our questions in the disclosure area pertain to this first question about decision useful information being reported. So first and foremost, we're interested in understanding whether the required disclosures achieve the disclosure objective as outlined by Bobby, which was about the amount, timing, and uncertainty of cash flows. Then Bobby also talked about the qualitative and quantitative disclosures. So as it pertains to the qualitative disclosures, we wonder if they convey useful information, and perhaps more specifically, if they're informative or boilerplate. And this is one place that, as an academic, I can totally see how we could use large-scale textual analysis to kind of provide some very helpful information in this area. Then in terms of quantitative disclosures, again, do they convey decision useful information? One other question here is whether there's incremental information in disclosures of certain judgments. So again, Bobby talked kind of about these ideas of the weighted average lease term, the discount rate. Is there incremental information in those disclosures? And then importantly too, we also are curious to know if there are disclosures that could be removed or if there are disclosures that should be added. So one benefit of the PIR process as it currently stands is that it's happening right after the standard has been implemented, and it's designed to help us allow to have some flexibility and adjust to what needs to happen in practice. And so research that can help us to understand what disclosures could be beneficial to add, or conversely, ones that are not particularly helpful and could be removed, would be very welcome. And then last, are the disclosures used to improve the comparability of the lease asset and liability information across entities? So this ties back to, at the beginning, we talked a lot about comparability being an objective of the standard. Are the disclosures helping to meet that objective? And then the other questions we have are about compliance. So we wonder if what the level of compliance is broadly with the disclosure requirements, and then as a subset of that, whether compliance varies across entities in a specific manner. That's all the questions we have here. So we'll pause for Q&A, but it again looks like we don't have any unanswered questions. So I'll talk a little bit about some additional educational opportunities and share some links that are available to you in the slides. So first, I wanted to highlight our upcoming webinars. So on March 19th, we have a webinar covering topic 606 on revenue. It will be a similar format to this. We'll have some of our great staff who are working on the PIR process come in and tell us a little bit there. And then similarly, on March 26th, we'll have one on topic 326, financial instruments credit losses. And then on July 13th, we're going to have an XBRL workshop, and I'll talk a little bit more about that on the next slide. On our academic landing page, where I shared at the beginning of the session, where the slides are posted, you can also see in the lower boxes the registration links to register for the upcoming March webinars, and at a later date, we'll include the registration link for this XBRL webinar. I wanted to talk a little bit more about this XBRL webinar. So it's XBRL and Academic Research, a workshop on how to pull XBRL data. And it's currently scheduled for July 13th of this year. And we'll have Beth Blankenspore, who has done other XBRL trainings. You might have seen her at last year's Spark meeting or at this year's FARS mid-year virtual meeting, giving a similar type of workshop. But in this case, Beth is actually going to adapt the materials to have a focus on revenue. So she'll kind of talk you through how you can pull XBRL data related to revenue and provide some skills that should transfer well to other settings as well. And in terms of why you might be interested in XBRL data, it allows you real-time access to the most recent corporate filings. So we all know the value of extra data, especially when you're looking at a new standard. There's not a lot of years worth of data, and CompuStat can have up to a 1-year lag at times for certain data. So XBRL could be a great opportunity to expand your data set and have more variables in that data set. If you're interested in learning more about XBRL right now, we actually have a video posted on our academic landing page from the FARS mid-year meeting. So you can navigate to the landing page and watch that video to see best training from that time. And then this slide just kind of summarizes all of the relevant links that we've highlighted throughout our talk today. So the conference webpage, we have both the topic 842 implementation webpage, so that's specific to the standard, the FASB PIR webpage, so that tells you a little bit more about the PIR process broadly, and then a link to our academic webpage, which, as I mentioned, is the place to go for the PowerPoint slides from today's presentation. We'll also post the video there at some point soon. The XBRL training video is there now, and then the webinar registration is also available for our upcoming webinars. And if you have any questions related to topics that were covered today or things that weren't covered today, I'm always happy to answer. You can reach me by emailing academics@fasb.org. And that email will always go to whoever the academic fellow is. So if 7 or 8 months from now, you know I'm no longer at the FASB, that email will still make it to our new postdoctoral fellow. And so with that, we'll just take any final questions.
Bobby has one I think she'd like to answer.
Yeah, the question is on disclosure requirements, if there is a requirement to disclose amendment of leases or if lessor or lessee is acquired by another company. So I'll go back to the objective. In the objective, it's specified that an entity would disclose the information that is necessary for users to assess the amount, timing, and uncertainty of cash flows arising from its leases. So there is no specific requirement that if there are no required disclosures for modifications or acquisitions in 842, but that objective would require an entity to assess if it's significant enough and whether information should be disclosed to enable the users to understand the effect of that. For the acquisition one, I do want to highlight the requirements under 805 on business combinations would also be applicable there. But 842 does not prescribe one specific requirement that requires lessees to. Lessees are required to apply judgment.
So while we wait for a moment just to see if any last questions come in, I just wanted to make the point that when you're conducting research and you're collecting a lot of data, there can be some really rich information that could be conveyed through descriptive statistics at the front end of your study that may go well beyond what you would normally put into a study. Often the descriptive statistics are there just to provide a sort of a global overview of what's going on with the sample. But if you have interesting data, I would encourage you as part of the study to really think about how those descriptive statistics could be utilized in order to provide us with some insights that we might not otherwise get as well, in addition to the testing that you do of your research questions. So I didn't have anything else to add. Do we have any other questions at this point, Jeff?
I don't see any other questions, so I'll turn it, I guess, back to you, Christine, to maybe, again, thank everyone and bring this to closure.
Absolutely. So yes, we're very pleased that you were able to join us today. And we are looking forward to reading your research. So we hope that this session has been useful to you. And we would encourage you to reach out with any questions that you might have on an ongoing basis, and just keep us in mind as you're conducting research, and don't be shy. about sharing the work that you're doing. That is very important to us here at the FASB. So with that, thank you to the team for helping out with the presentation today, and I wish you all a good weekend. Take care now.
Take care.